The stock market is currently facing high levels of volatility with major indexes in market correction territory due to escalating global trade tensions and economic uncertainty, leaving everyone wondering what's coming next. And in today's video, I'm going to be talking about the 7 essential ETFs that you need to know about to help protect your portfolio during a stock market crash or any sort of downturn. So whether you're just getting started or you've been investing for some time now, owning these ETFs can help preserve your wealth when the markets decline. First up is defensive ETFs. Having exposure to defensive stocks can help reduce risk in your portfolio. Just as the name suggests, these stocks can be used as a buffer to help weather downturns in the market, as they often provide you with stable performance, reliable earnings, and dividend income. The companies in these sectors are geared towards essential goods and services that people need and depend on consistently. During downturns or recessions, while people may slow down on spending for non-essentials, they're unlikely to stop paying for things like groceries, electricity, and medication unless they're facing some extreme financial hardship. Now, there are 3 defensive sectors. The first one is consumer staples. Consumer staples ETFs, are also known as consumer non-cyclicals, include companies that provide essential services and goods that people use day to day, regardless of the economic conditions. So this could be things like the manufacturing of personal and household products, beverages, food, and tobacco. And some of these companies I'm sure you're familiar with, like Procter & Gamble, Walmart, Costco, and Coca-Cola. The second one is healthcare. Now this sector ETF would include pharmaceuticals, biotechnology, medical equipment and supplies, long-term care facilities, hospitals, insurance, and much more. Essentially anything that you can think of healthcare related. And since medicine, medical equipment, and healthcare are pretty much always in demand, this sector gives you defensive opportunities. The third one is utilities. These sector ETFs would include companies that produce or distribute essential services like water, gas, and electricity, and this also includes renewable energy sources like wind and solar. The value of stocks in this sector stay pretty stable when you consider that even in downturns or recessions, spending on utilities are not as likely to drop. Here's a list of a few different defensive ETFs that you can also look into, also for each one of these sectors. Having to choose one ETF from each sector, my first pick for consumer staples is VDC, Vanguard's Consumer Staples ETF. This ETF holds 103 stocks and invests in large, mid, and small cap stocks in the consumer staples sector. For healthcare, we have XLV, the Healthcare Select Sector Spider Fund. This fund has 60 holdings and it tracks the Healthcare Select Sector Index, which is primarily large cap with some mid cap companies and a variety of healthcare industries. For utilities, FUTY, Fidelity MSCI Utilities Index ETF, this fund holds 69 stocks and tracks the MSCI USA IMI Utilities Index, which contains mostly mid cap along with large and small cap utility companies. When stocks are taking a beating, it's nice to have some holdings that not only offer some added stability, but also provide you with a steady stream of income. Which leads me to this next one, dividend ETFs. Dividend ETFs hold stocks that pay dividends, which are a portion of a company's profits that are paid out to investors. And while all these types of ETFs pay you a dividend, they can differ in their strategies, such as some dividend ETFs may focus on stocks with a strong history of growing dividends, while for others, it may be having a high dividend yield or even a mix of both. In times when there's a market correction or we're in a bear market, this is when dividend ETFs can really shine for a few reasons. One is a consistent stream of income, since regardless if stock prices are going lower, the dividend income from these ETFs are going to be paying you on a regular basis, for example, every month or every quarter. Second is that many companies that pay dividends have solid financials and a strong history of stable cash flow and earnings, making them more resilient and stable during downturns. This also makes them have less volatility compared to the stock market as a whole. And while they do pay you an income, they also have the potential for capital appreciation on top of that income and the additional value from diversification. There are a lot of great dividend ETFs, so here's a list of some that you can look into. But if there's one that I had to pick, it would be SCHD, the Charles Schwab US Dividend Equity ETF. This ETF tracks the performance of the Dow Jones US Dividend 100 Index. And this index focuses on high-quality dividend stocks from stable companies with high yields that pay dividends consistently. What sets SHD apart is its impressive dividend yield of over 4%, which is paid out quarterly, and its incredible dividend growth, with its dividend payouts increasing every single year for the last 13 years in a row, which is more money paid to you. And you can see over the last 10 years, it's had some pretty good returns, giving annualized returns of around 10% over this time period and 14% in the last 5 years. This is just to show you an example of one dividend ETF that has great balance between consistent and strong dividend growth along with a solid dividend yield. This next ETF is gold. I think it's fair to say that gold is one of the oldest and widely accepted hedge against market crashes, inflation, or any other economic or geopolitical issues. Precious metals, especially gold, are viewed not only as an investment, but a reliable store of value in good and challenging times. And gold is considered to be an uncorrelated asset, which just means it doesn't follow the same movements and patterns as the stock market. Now, instead of actually purchasing physical gold, you can invest in a physically backed gold ETF in which these ETFs own the gold and have it stored in vaults. Just be aware that there's also gold mining ETFs, and these invest in the stocks of the gold mining companies which are doing exploration, development, and production of gold from mines, so they're not the same thing at all. When it comes to the performance of gold, looking over the years, it's done pretty decent. In the last 20 years, it's actually outperformed the S&P 500 starting back from the early 2000s, but a little further out to 30 years, and you'll see that the S&P 500 outpaced it, as well as more recently in the past 10 years or so. Here's a few different gold ETFs that you can take a look at. For me, I think IAUM, the iShares Gold Trust Micro ETF, is one of the best gold ETFs to buy. The reason why is it has a competitively low expense ratio compared to other gold ETFs. You also have IAU from iShares, which is essentially the same thing, but the difference is it has a higher expense ratio and it has more liquidity, which is more important for traders. While gold isn't the choice for high growth and returns, it does have the potential for some decent returns, as well as having the additional diversification considering it moves independently from stocks and bonds. The next ETF is going to be bonds. While bonds might not get as much attention as more exciting investments like stocks, they can still play an important role in keeping a portfolio balanced. Bonds can help lower overall risk when combined with stocks or any other assets. And compared to stocks, they're less volatile and less sensitive to market fluctuations. The prices of bonds typically move in the opposite direction of stocks. When stock prices are going down, bond prices tend to go up and vice versa. The purpose of having them in a portfolio is for their stability and not for high growth potential. This is especially important for those nearing retirement looking to shift from growth to preservation, along with having the added benefit of some income. Now, let's talk about how bonds work. Bonds are essentially IOUs issued by borrowers, so governments, corporations, or other entities, to investors. When you buy a bond, you're lending money to the company or government, which they promise to pay you back your original amount of money on a specific date in the future, which is called the maturity date. During this time, the company or government is also paying you interest regularly over the life of the bond, and this interest payment is called the coupon rate. And if that went over your head, think about it like this. You give your friend $100, so that's buying a bond. They promise to pay you $5 every year, that's the coupon payment, and then give you back your $100 after 5 years, so that's the maturity date. So you lend money, you get recurring interest payments, then you get your original money back in the end. That's the simple breakdown of how bonds work. They're a way for government and organizations to borrow money from the public with a promise to pay it back with interest. Now, bond ETFs are just a basket of different bonds, and these bonds could be from governments, companies, or other entities, and there could be a mix of all of them together. Just like I had explained earlier about bonds paying interest, it works the same way with bond ETFs. The ETF collects all the interest and it pays it out to the investors, which is usually as a monthly dividend. And here's a list of some bond ETFs that you can look into. There's a variety of bonds, but having to pick one, I'd have to say BND, the Vanguard Total Bond Market Index Fund ETF. This ETF gives you exposure to US government and corporate bonds with a mix of short, intermediate, and long maturities. Next, we have foundational or broad market ETFs. With any portfolio, it's key to have a solid foundation as it lays the groundwork for effective diversification. And this would be through something that gives you broad exposure to the market, but not in a way that makes you vulnerable to any unnecessary risk. Broad market ETFs provide you with diversification across a wide variety of stocks and sectors. This is key because it reduces how much negative impact a single stock or a sector can have on your portfolio, and this is even more important during downturns and bear markets where a variety of stocks and sectors are declining. These types of ETFs can give you exposure to the S&P 500 index, so the largest 500 companies in the US, or the entire US stock market, which would be all the stocks in the US, or even a total world ETF, which will hold all the stocks from all over the world, meaning the US and all the international stocks. Now, here's a list of some broad market ETFs that you can look into later on. Some of my favorite include VU, Vanguard's S&P 500 ETF, VTI, Vanguard's Total US Stock Market ETF, and VT, Vanguard's Total World Stock ETF. While all these offer a great variety of holdings, the more holdings between these different ETFs, the more diversification you're going to have. The choice is ultimately yours. It's hard to go wrong here. Now, I do want to say, keep in mind that historically, bear markets are followed by periods of recovery. So by being and staying exposed to these broad market ETFs, you position yourself to benefit once the market eventually recovers again. I believe it's important to have some type of defensive strategy or approach that's incorporated into your portfolio. And it's not only for preventing larger losses during downturns or recessions, but to reduce your overall portfolio risk. This doesn't mean that you need to have each one of these ETFs to successfully do that. Your age, risk level, and investing strategy is going to play a big part in which ETFs that'll be best for you and how much to allocate towards each one. And as we get older or certain priorities change in our lives, so will our investing strategy. And that's completely normal. I hope this gives you a better idea of some different types of ETFs that you can incorporate into your portfolio, not only to help it be more resilient for rough times, but also just to further expand your diversification. And if you want to see what's the one ETF that I'd choose if I could only pick one to invest in, be sure to check out this video here, or if you want to see more options of some great ETFs, take a look at this one here. As always, thank you for watching, and I'll see you in the next one.